And a lot of people are asking, so are we actually in a bubble? I actually try to ask the same question to ChatGPT, if there's a hype and also is there a bubble. So here's the answer. The AI sector's high valuations driven by growth potential and technological advancements have sparked debate about a possible bubble, but predicting such trends is inherently uncertain. So I guess, yeah, it quoted all the right information, but it's pretty much useless.
All right. Hi, everybody. Good evening. Thank you for attending today's session on our live market commentary. This is where we talk about the latest developments in the financial markets, and this is also where we share our views on them. I'm Albert. I'm the Deputy Country Manager here in Malaysia, and I'll be your host for today's session. As always, we are joined here by Stephanie, who is our Chief Investment Officer. Hi, Stephanie. How are you?
Hi, Albert. Hi, everyone.
Hi. We just conducted our second half market outlook last week. We recapped on the first half of the year. We also shared our views on the market for the remainder of the year. So that was a webinar which we did online, and that video should be out very soon on YouTube if any of you might have missed that one. But if you can't wait for the video to come out, in the meantime, you can always check out our article that also talks about our market outlook for the second half of the year, and you can just easily do that by Googling StashAway second half market outlook. All right. Today, I want to focus on the performance of the S&P itself. For the first half in this year, we've seen the S&P rally a staggering 17% in US dollar terms. And that's a very high, high return that we've seen. And it's very impressive given the various events that have happened. We've talked about it over the course of this show. We talked about SVB, we talked about the US debt ceilings, and we've talked about how steep rate hikes have been by the US Fed. However, the devil, I feel, is in the details itself. When you look into the S&P, what drives the performance of the S&P, right? So when you look at the S&P, majority of the gains actually comes from AI-related names like NVIDIA, Microsoft, and Alphabet. This was further boosted by yesterday's NVIDIA's earnings, which they gave very, very good sales forecasts that beat the street numbers. And that kind of fueled the whole surging demand for AI processors and helped boosted NVIDIA stock on top of that. So my question to you, Stephanie, today is, given how much hype that has been in AI, especially since last year when ChatGPT first launched, do you really see a bubble forming within this space?
Today is a very interesting day because NVIDIA just gave out the latest earnings. Now, of course, 3 months ago when they gave their guidance for the second quarter, that also had a blowout quarter, which is why, that propelled the stock much higher. And subsequently, fueled like a rally in AI-related names, particularly in some of the big cap companies that have been beaten down in 2022. So I think what we've seen so far, as Albert mentioned, is pretty much an AI-driven rally. So if you kind of look at the S&P itself, like year to date, it's up 17% or so. But if you just take out the AI companies, it's only up low to single digit. It's actually up less than 5%. So most of those gains actually come from a very focused group of companies. And a lot of people are asking, so are we actually in a bubble? I actually try to ask the same question to ChatGPT just to see how it will respond. And so I asked ChatGPT to give me one sentence answer if there's a hype and also is there a bubble. So here's the answer. The AI sector's high valuations driven by growth potential and technological advancements have sparked debate about a possible bubble, but predicting such trends is inherently uncertain. So I guess, yeah, it quoted all the right information, but it's pretty much useless. I think which shows us two things. Number one is that, of course, we're still very early in the cycle. So if you think back 6 months ago, nobody was using ChatGPT. AI was very, very different from the AI that we're seeing right now. So there's still a lot of developments that would go on in the next few months or even few years or even a decade. So I think what we're seeing is a flight to the obvious winners, which are, of course, the bigger tech companies, and NVIDIA, of course, being the manufacturer of the GPUs, which are used to train these models, has been some of the easiest ways to get exposure into the sector. The second implication from this reply from ChatGPT is, of course, like when we all use ChatGPT, just kind of use it with a grain of salt. It's a great tool, but there's still a lot to be demanded. So I think there's still a lot of opportunities that are out there to invest in AI, and it's not just kind of confined to these like small group of maybe 7 companies. I think if you look at how AI will change many industries, including our industry in fintech, it actually can increase productivity in a lot of kind of core functions, and also perhaps, increase revenues as well. So I think actually as time goes on, we'll see the benefits of AI kind of expanding from a very narrow set into maybe firstly the broader tech sector. For example, a lot of the cloud players actually benefit from the use of AI because when you use AI, it requires quite a lot of computing power. And like for a lot of companies, the only economical way to get exposure is to use a cloud service. So that would be, for example, an adjacent group of companies that would benefit. Fintechs, for example, as I said, or even e-commerce companies and like kind of life science companies also benefit from the advancement in AI. And perhaps, it would actually expand into much kind of older or more mature industries eventually as well. So I think, of course, a lot of things have like, if you just focus on a small group of companies, those are quite expensive. But for the rest of the economy, or even for the equity market as a whole, I think the benefits are still to be seen. One other kind of comment I'll make on this is that I think year to date, the performance of these AI stocks and the S&P actually shows us the power of having a diversified exposure in the index itself. Because if you try to pick certain sectors or certain stocks, and if you didn't pick those 7, basically this year, like there would be very, very dismal return. So if we don't have time, or if we don't have resources to do a lot of deep work in a particular sector or even a stock, then having kind of broad exposure to the index ensures that you actually enjoy the benefit of some of these unexpected areas of boom.
Thanks, Stephanie. And the AI boom that we've seen is, I guess, is one half of the story when it comes to the S&P 500. So when you look at the other half of the S&P 500, right, if you just look at the returns that they have driven in the first half of the year, I think the returns is roughly 2%, and it's dismal in comparison to what the other half has performed. And so this could be me just trying to read the tea leaves here, but looking at it in a very simplistic manner, does that mean that from a growth perspective in the US, it's not that great for the broader economy? Is it just within the AI sector or the tech sector where everything is doing fine and dandy compared to the rest of the US economy where things might be not so great? And we've seen calls for recession early this year itself. It's probably one of the most highly predicted probabilities for a recession this year, and that stands in contrast with the economic data that has been coming out over the past few months, where we've seen strong retail sales data. We have seen unemployment rate at all-time lows. What do you think about that, Stephanie?
Actually, if you look at different segments of the S&P, particularly those that are more kind of sensitive to the economy, those are actually trading very poorly. For example, if you look at the banks, they are actually close to 1-year low, or for some companies are actually close to even COVID lows. So that is telling you that the historical kind of historically fast pace of rate hikes, now we're surpassing 5%, is actually having impact on some parts of the economy. And as we kind of lay out in our outlook piece, in the US, we're actually seeing something that we call a 2-speed economy. On the one hand, if you look at the industrial sector, for example, if you look at the PMI, which we track on a monthly basis on manufacturing, it's been contracting already for the past 6 months or so. And a lot of that is actually driven by a surge in COVID demand during the lockdown period. So the US consumers, when they were kind of stuck at home, what they did was basically they went on Amazon and bought up everything that they could, to the extent that they actually pre-spent 4 years of goods consumption, which is why you're not seeing much growth in terms of the manufacturing sector, or because the US consumer, in terms of buying iPhones, in terms of buying cars or refrigerators or TVs, those demand is actually very low. On the other hand, however, if you look at the unemployment rate, US unemployment rate is still hovering around all-time low, which means that the labor market is actually very, very strong. And the reason for that is also partly related to COVID. If we all remember, during COVID, the term that was used back then was the Great Resignation. A lot of people actually left their jobs. Some of them actually came back to work, but a large portion of them actually didn't come back to work. And some of them are because they are early retirees. If you're kind of close to retirement age, once you kind of take the decision to retire, it's very hard for you to go back to find a job, or you don't need to go back to find a job. Some of that is due to changes in cities, or people are starting to work from home. So you no longer want to work, like kind of go back to that restaurant server job that you were doing before COVID. So there's a lot of these structural factors which cause the labor market to remain actually still quite tight even today. Even though it's getting better and better, this needs time to work out. So actually, for the next few months, or even for the next few quarters, we still expect the labor market to perhaps, cool down a little bit, but still remain relatively tight, which means that on the service consumption side, that would still be quite robust. So we're seeing actually a two-speed economy going on in the US. That actually is playing out in the stock market as well.
You talked about factors impacting inflation and all, but if you look at the other side of the world, we have China, where things seem to be spiraling into like a deflationary period. We've seen their CPI declining in July. We have their PPI, which is producer index, is also down in that month itself. We have seen a slew of policies coming out from the government trying to prop up not only the property sector, but also encouraging the local Chinese to purchase more. And so there's been a lot of growth concerns surrounding China itself, right? All these policies that has been rolled out doesn't seem to be inspiring confidence, at least on the market side. So what do you make of this, Stephanie? Because you mentioned, okay, US still seems to be fairly strong, but maybe weakening. But on the other hand, we have China, which from an economic growth perspective seems to be quite worrying.
The economic picture in China is a lot more complicated compared to, for example, the US. And part of that is because, as we mentioned, the US consumer is not buying goods. And as we all know, China actually relies still quite a lot on export to the US consumer. So that pillar of growth from China is actually quite weak. And indeed, if we look at the latest numbers, for example, new export orders in the PMI itself actually contracted at the fastest pace since September 2022. So that part of the economy is actually not providing a lot of support. And on the other hand, some of the domestic sectors, namely property and also the internet sector, has also been subject to a lot of regulatory constraints and clampdowns. And therefore, those two pillars, we're not seeing a lot of growth either. So, for example, the property sector as a whole contributes somewhere around 30% of China's GDP. And if there is growth concerns in that sector, it actually can kind of bubble out into other sectors. For example, the banking sector or the local government financing vehicles are being impacted as well. So there's quite a bit of ripple effect. The Chinese government will try to backstop these bubble effects from spiraling out into much broader systemic problem. That's why we're seeing quite a number of policies put in place in the past few weeks, or even going back further. However, they are not going to put out a big bazooka like what they did, I guess, in 2009 or even as recently as 2015, 16, when they were trying to rescue the asset markets. The reason is because of the debt that these Chinese property or these Chinese private plus semi-public sectors have accumulated since the financial crisis has already reached levels that are quite alarming. So from a China policymakers' point of view, they actually do not want to continue to lever up the economy because they understand that this is not a sustainable kind of way of growth. And also taking lessons from Japan, the Japanese economic bubble actually kind of went out of control and burst in the 80s. And of course, I mean, as we all know, that resulted in 40 years of what we call a lost decade, where productivity and economic growth are all very, very subdued. And if you look at the Nikkei, which is the stock market there, it just, I mean, recently went back to where it was 40 years ago. So the good thing is that the Chinese policymakers have Japan as a lesson to kind of look at and also to review. One very significant difference that we're seeing today in China versus Japan is that the Chinese policymakers are taking more proactive steps to loosen the financial conditions in China, whereas in Japan, at the early stage of the bubble burst, the Japanese authorities was actually more hawkish, much more hawkish. So I think there are, of course, a lot of similarities, and a lot of people are asking, is China going to be the next Japan? But I think the difference here is that at least the Chinese policymakers can take a lesson from the missteps that Japan had. Lastly, we also look at some of the leading indicators for the Chinese economies. Now, of course, the manufacturing PMI has been contracting for a few months now. However, the service PMIs have actually still been expanding, so they are still relatively quite healthy. And also, if you look at iron ore prices, which is also a pretty good leading indicator of the economy because it's more upstream. In August, it actually recovered quite significantly. So at least in those parts of the economy, I think we're seeing some response from the government stimulus. And I mean, just from our experience, when the Chinese economy is turning, it's not a kind of a quick process, just given it the size of the economy. So from the time when the government starts to stimulate to when the economy actually sees the impact, there is a certain time lag. So I don't think we're in for a very, very systemic risk in terms of Chinese economy collapsing, but I don't expect the government to come out with like guns blazing to create another as a bubble either.
Yeah, I guess time will tell on that in terms of how things progress in China. If any of you have questions based on what we're talking about today, please feel free to post them in the side chat and we'll address them. We've got a question here from Jack, and so he's asking relating to the topic about AI. How much of our StashAway portfolios is going to have AI incorporated into it?
So if you kind of look at the StashAway portfolios, we have the general investing portfolio, which is a global asset allocation portfolio, which means that according to different risk points, different SRIs, they actually invested in, I guess, slightly different mix of global equities and global bonds. So for the higher SRI portfolios, they have more exposure to stocks. And within the stock exposure, we do have an overweight to US technology, which, I mean, of course, by definition, is dominated by these big cap tech names, which benefit from AI. For the lower risk SRI portfolios, by definition, they have lower exposure. In terms of the other way to get exposure through StashAway is through our thematic investment baskets. So we have 4 thematic baskets, and the one that is most exposed to AI would be Tech Enabler. So within Tech Enabler, we do have ETFs that are exposed to robotics, to clouds. So those are some of the ways to get exposure to AI through the StashAway platform.
Okay. Yeah, that's how you can get some exposure there. And I think that's the only question that we have for today. I'll just maybe pause for a little bit in case there are any additional questions that might come in.
Yeah, just to add, I guess, to Jack's question, to see the exact allocation to these AI-related ETFs, you can go into our app and click on to the particular portfolio. So within that portfolio, you can see like how much is actually allocated.
Yep. Okay, well, that seems to be all for today. I hope this session has been enlightening as we talk about AI and also on China itself. Thank you, everyone. Thank you, Stephanie, for sharing your insights today. If you have any other questions on StashAway, please feel free to write into us at support@stashaway.com, and we'll be able to to address them. All right, everyone. Thank you so much, and have a good night. Take care.
All right. Thank you, Albert. And everyone have a good night. Bye.
Bye-bye.